What's going on, guys? My name is Nick, and if you're new to my channel, welcome to Investing Engineered. I'm really excited to be sharing this video with you today because I'm going to be talking about my top favorite dividend stocks, both that I own and stocks that I hope to own in the near future. Before I get into the video, I just want to say that dividends are truly the essence of investing. And for those of you who aren't familiar with what dividends actually are, they are simply cash disbursements that you can get by simply holding shares of companies, and they're typically paid out on a quarterly or every 3 months basis. Now, although these dividends are not guaranteed by any means, they are a very reliable source of income. Companies generally want to try and continue paying dividends as well as growing them over the years to demonstrate strength in their organization. So if you don't own any dividend paying companies, I would highly recommend them because they are a great source of passive income. And so if you do enjoy this video, be sure to smash the like button for me. And don't forget to subscribe for more content on personal finance, business, and investing in the near future. Anyways, without further ado, let's jump into my favorite mix of dividend-paying stocks. Alright, so up first, we have a company called Fortis. Fortis is one of North America's leading utility companies, and they specialize in the distribution of electricity and natural gas. Being a sustainable energy company, they also play a big role in solar power through their acquisition of Tucson Electric Power. Now, getting straight into their financials, Fortis has shown a very impressive track record in terms of their dividend payments. Fortis has been paying and growing their dividends for over 45 years, and this is probably one of the best performances I've ever seen in terms of dividend payments. And management actually projects that the dividends will continue growing at a rate of about 6% per year, all the way through 2023. And so just knowing this, if you're a long-term dividend investor, this is very good news. Furthermore, the company has shown incredible stock performance, as can be seen from this all-time chart on Google. In fact, I found from their 2018 annual shareholder report that Fortis has posted above average returns for over the past 20 years. Over the past 20-year period, Fortis has returned 12.4% per year back to its shareholders, and this compares to the S&P Composite Index in Canada being only 6.6% per year on average. So it's essentially doubling the returns of the Canadian stock market index. Now, because of this amazing growth over recent years, their dividend yield is only about 3.3% currently, with a payout ratio of 49%. Now, 3.3% dividend yield really isn't that bad starting out, but I could see a dip happening in the near future, and this could bring their yield past 4%. A company like Fortis is a company that many investors should keep their eyes peeled for because utility companies are known to be very stable in both good and bad economic times. This is because of their sheer volume of power lines, pipelines, and other infrastructure that gives them a very strong competitive moat, meaning that the company is very protected from competitors entering the industry and taking their market share, because it would take so much time and money to actually build all of that infrastructure up. Now, as for my thoughts on the company, I think it's an amazing company, but I currently would not buy the stock because it has risen at least 20% in 2019 alone. But this is definitely one stock that I'm keeping on my radar, and if it does undergo a dip in the near future, I'll be the first one to buy, because this company is guaranteed to be a quality buy for the long term. Alright, so the second company is actually the largest pulp and paper producer in the world, and that is International Paper. International Paper's worldwide business is divided up into 3 main categories, first being global cellulose fibers, second is corrugated packaging, and third is main papers. And these could include many things like baby diapers, boxes for Amazon, tissues, etc. So currently, International Paper has been experiencing some very difficult market conditions, a lot in part due to the trade tensions between the US and China, but also the slowing demand in paper products, as well as the rough times that they're experiencing in their industry, has been causing the stock to drop over the past 2 years. However, as we can see, their current dividend yield is above 5%, with their payout ratio being only 38%. Both a very attractive starting yield for anyone considering to buy the stock at these levels, but also with the low payout ratio, it provides a cushion for when their earnings do decrease in bad economic times. Additionally, it should be noted that the company has been paying dividends consistently for over 47 years, while they've actually been increasing their dividends since the Great Recession. Now, although the stock got absolutely destroyed in the past recession, this should not deter you from buying the stock because it has fully recovered since and made a 600% return. And over that entire period since the crash, they've been increasing their dividends year over year. Furthermore, the company's current valuation is actually below a price to earnings ratio of 10, which is far below the industry and the company's 5-year average price to earnings ratio of 20. So this would be a great stock for both dividend investors and value investors alike. So personally, I would definitely consider buying this stock below $40 per share, as I think it's a great deal right now. But I also don't see things getting much better for the pulp and paper industry in the short term, so I might hold off until the stock drops a little bit more and then buy at a discount. So be sure to keep that in mind if you do choose to invest in international paper. Alright, so thirdly, one of the stocks that I currently own and that has been a great dividend payer is the Royal Bank of Canada. Yes, I know, another Canadian stock, but if you are in the US, they do have a ticker symbol RY on the New York Stock Exchange. So here in Canada, RBC is the largest bank by market capitalization, and they focus primarily on the personal and commercial banking sectors all across North America. Financially, the bank has done very well over the long term, as you can see from their all-time stock performance. Furthermore, the company has been increasing their dividends consistently every single year since the Great Recession in 2008. It should also be noted that RBC did not cut or even lower their dividends whatsoever during the Great Recession, and this was one of the toughest times for banks. So over the past 10 years since 2009, their dividend increases have been about 7% per year. And that has allowed their current dividend yield to be about 4%, while their dividend payout ratio is about 58% of their earnings. So this is definitely a great starting yield, and it also provides a lot of room for the dividend to grow into the future. Another thing that you do need to know about RBC is the fact that they've been around for over 155 years. And since their inception, they've done nothing but flourish. So honestly, you have very little to worry about when you're considering RBC as an investment. People and businesses are always going to continue getting loans for real estate, and with RBC being the largest and most well-known bank in Canada, along with their entrance into the US, they have plenty of room to grow. So like I said earlier, I personally have a stake in this company, and I plan on building that stake even larger whenever the stock drops to lower levels. Alright guys, moving on to the fourth dividend company, and that is AbbVie. AbbVie is a global biopharmaceutical company that focuses on the research and development of medicines to treat very terrible diseases. That could be hepatitis A, rheumatoid arthritis, etc. And their best-selling drug Humira is actually the #1 best-selling drug in the world, having posted sales upwards of $20 billion in 2018 alone. So up until this point, the company has had full rights and essentially a monopoly on selling this drug without competition here in North America and across the world. But recently their patents ran out in Europe, so now they're facing a lot of competition there. And then in 2023, the same thing is going to happen here in North America, where other biosimilar drugs are going to enter the market. So jumping into their financials, we can find that the stock has performed very well since their inception in 2013. Now contrasting this with the past year's performance, we can find that the company has actually dropped about 35%, from $100 per share down to only $64 per share in 2019. But this has provided a great buying opportunity for dividend investors because their current yield is over 6.5%. Furthermore, when we look at their dividend history, we can find that they've been increasing their dividends consistently every single year since 2013. And their 5-year dividend growth rate has actually been a massive 16.9% per year, which is absolutely insane. Along with that, their dividend payout ratio is only 54%, which is very impressive for the yield that it offers. Alright, so we all know that the dividend is pretty great, but what are my thoughts on the company? And so because I put them in this list, I honestly think they're one of the greatest dividend plays right now in the US market, because they've been growing their dividends so fast and so consistently over the past 5 years, but also that they have an attractive starting yield and a low payout ratio. However, I am also very concerned for the future of this company because they will be losing biosimilar rights for Humira in 2023 in North America. And since the company's earnings are so highly dependent on the sales of this one drug, I think this might pose some problems in the future unless they have another drug to come and replace it or they diversify their portfolio better. But up until this point, the company has shown strength in numbers, and it'll definitely continue to grow if they can manage to diversify their portfolio. And so for that reason, I'll be keeping my eye out for a deal under $60 per share. Alright guys, last but not least, my favorite dividend paying stock in the oil and gas sector is Suncor Energy. And something to keep in mind is that Suncor is actually one of Warren Buffett's newest holdings. Suncor is Canada's largest integrated energy company, and they focus on both upstream production of oil sands, but also the downstream refining sector. Therefore, Suncor produces and refines all of the gasoline for over 1,500 Petro-Canada stations across Canada. The company also has offshore operations off the east coast of Canada through their joint ventures in Hibernia, White Rose, and Hebron. So obviously this company is very well diversified in terms of oil and gas, but let's take a look at their financials. So over the past 20 years, the company has been on an absolute tear despite the volatility in crude oil prices. But as a result of the uncertainty in the Canadian oil and gas sector right now, this company is hitting support levels at about $37 per share. And this corresponds to a price to earnings ratio of 10 and a price to book value below 1.3. But obviously all of this is very good news for long-term dividend investors and value investors alike. Suncor has a current dividend yield of 4.5%, and their current payout ratio is about 50%. Furthermore, the company has shown strength through their consistent dividend payments over the past 26 years, and by increasing their dividends consistently over the past 16 years. And over the past decade, their annual dividend growth rate has been 21% per year, which is absolutely insane. So overall, Suncor has proven to produce long-term shareholder returns through share repurchases, capital appreciation, and dividend increases. And honestly guys, through making this video, I reaffirmed my bullish position because I had to do a bunch of research on this. And so I plan to keep buying more shares at these discounted prices in the near future. Because honestly, oil and gas is not going anywhere for the near term, even though renewable technologies are coming out. Anyways, I hope you gathered some valuable information on these amazing dividend stocks. And please do let me know in the comments section if you do plan on buying any of these and what your thoughts are on these stocks. So if you did enjoy or gain value from this video whatsoever, just be sure to smash the like button for me. And of course, if you haven't already, you'll definitely want to subscribe for more content on personal finance, business, and investing in the future. Until next time.